Hello, folks. To Brandon chatting with you today. It's another edition of the TheoTrade Monday video for December 16th, 2024. Boy, the holidays are approaching. The Christmas rally, the Santa Claus rally between Christmas and New Year's. Everyone's banking on a big move in the broader markets, and we'll see. We're kind of seeing a contract change event here. Let's go to the SPY to take a look at the broader market today. I'm going to talk about why these are the only stocks that matter right now. And I'll also give you an opportunity how to speculate on a couple that may be showing some bullish and bearish opportunities. So let's start with the S&P. We got this print back on the 5th. And again, we're looking forward, right? Not backward. A lot of people, use technical analysis as a crutch. They say, well, look, the price is going up, therefore it will always go up. They don't account for the fact that within the body of knowledge of technical analysis, at major turning points, they're always wrong. So how do we know how to manage risk and reward both simultaneously? And this is the big deal, because if we look at the S&P at the current level right now, and we say, look, volatility markets, and I shared this on my last 2 weeks of videos as to why we're at a very high risk level right now for the broader market. Why you might want to consider taking profits and hedging and managing those gains versus exposing them. I could say, look, the S&P might drop 5%, or maybe, let's say, for example, the market drops 8% a la July. Do you realize if you had the average NASDAQ stock during the July decline of 8% of the S&P, 13% in the NASDAQ, you would have had an average loss or drawdown of 46%? Most people are holding stocks that are carrying significant amount of directional risk. And the question is, what's the plan, right? When do you plan on taking profits? Because right now, who the heck knows what's going on with the market and where the market's going to go? Now, why do I know that? All you have to do is come over here and you'll see a Avago. Okay, well, Broadcom now, for example. Yes, they had earnings. Yes, we saw a big pop today and a big pop on Friday. Well, behind the surface, behind the scenes, there's some significant put option buying today in Avago. The 27 October expiration. Let me flip this to implied volatility volume and open interest. Scroll down, you got 23,000 puts, mostly bought at 220. So while we're celebrating that the Broadcom's up 11% today, the top performer in the S&P 100, behind the scenes, we have significant put option activity in Avago saying, hey, I think Avago may go down. And 220, boy, is it a very far stretch to expect the low of the gap day to be tested at 211? Of course not, right? That happens frequently. We had gaps back here, had a nice couple of days. We pulled back, actually finished through the gap halfway. We rallied again and eventually gave it all back. So while we're celebrating, right, and we're cheering, are we dropping the ball before we cross the goal line? It's just like those, the back's got the ball, they're running for the end zone, all of a sudden they drop it right before they cross the end zone and they don't score the touchdown. So, well, how do I know? Again, only a handful of stocks really matter. Again, look, Tesla, Google, right? We've got Amazon in the mix here. We've got Apple in the mix. We've got Meta. What do we call these stocks? They're called the Magnificent Seven. Why do we call them Magnificent Seven? These are the largest market cap stocks out there, with the exception of NVIDIA today, that saw some selling pressure about 1.5%. Microsoft wasn't towards the top of the list, but it was still up 1% today. As we consider, and again, we look at these kind of percentage change here, again, these stocks are topping the list. These are the biggest market cap stocks in the market. Why are we going there? And I shared this last week during my session, last Tuesday, as to why we're looking at these companies right now. Nobody knows where the market's going in 2025. I understand expectations are through the roof. How many times have you gotten 20+% returns 3 years running? What's the dollar going to do next year? What are some of the policies, austerity measures that may be passed? How are they going to impact the market and the economy? Right now, we're running massive, unheard of trade deficits. Fiscal deficits and probably trade deficits too. Okay, yeah, that helps prop up stocks a little bit as the dollar weakens intrinsically. How long is that one-way road going to last? I don't know. And how do I know that there's a lot of uncertainty right now? Well, let's take a look at Skew. And I get it. I look at this a lot. This is not a timing indicator, by the way. We don't look at Skew to say the market's going to go down tomorrow. All we can say is that if we look back historically, the degree of hedging we've seen over the last few weeks, we've never seen that before in the past. We look at the S&P 500 today and we say, okay, well, the S&P's higher, 0.4%. And yet what? The VIX went up today. Let's go back to a daily chart, right? The low-hanging fruit of squashing volatility, selling volatility, driving up the S&P because they're inversely correlated. All of a sudden today, we see a decent move in the VIX, 0.8, almost a single point on the VIX. And yet the S&P was also up 0.4%. You don't see this very often. Skew, what's going to happen? I'm not sure. Normally the VIX goes up. You should see Skew come down a little bit. We'll see what happens. But today we definitely saw some potential put option buying as the VIX is going up, as the market's going up as well. The guarded nature of the market tells us something. The fact that we're going back to these magnificent 7 stocks, and why are they there? They're there because if the market goes up, these are the names that are going to be going up as well. Right? And if the market goes down, how can I go wrong? I own Amazon. I own Apple. I own Microsoft. I own all these big cap tech names that represent the majority of the movement in the market are driven by these stocks in most of the last couple of years. So why not be in these companies? That was the exact argument I provided last week. Okay. I think it was last Tuesday for why you should own the Magnificent Seven if you think the market's going higher. But let's go back to if you think the market's going higher. Can it? Absolutely it can. The market can go higher. But we did see back on the 5th, there was a significant print in the SPY on the 5th at 1.3 million shares traded at 607.62. It didn't look like a very significant level at the time, but guess what? It's proven to be significant almost every day since. So what does this mean? We now have a level that matters. We have stocks that are driving the market, and we have a level that if we take it out, we may have a chance of making another laborious leg higher. Why do I say laborious? Look at Skew. What does Skew tell us? It says that institutions have never been more hedged from a volatility perspective, selling calls and buying puts. But part of the downside risk that's reflected in this, the crash risk in the market, is also the other side of the bell curve. The other side of the bell curve suggests they're going to see a higher frequency of small up days. Are we seeing that? Well, today's range, what is it? Today's range was $2.57. What is the average true range on the market right now? Bring up the ATR study, say, okay, the average true range has been declining, but it's $4.30. We're $1.50 less than what the average true range is for the S&P. If we go higher, it's going to be under a very labored approach, and it might just be led with the Magnificent Seven leading and everything else dragging. Is today a microcosm of that? Let's look at $ADVN. This is advancing issues in the New York Stock Exchange, plus $DECN. This creates a composite symbol. That's the candles here in the back. I want to look at the ratio. I have a pairs ratio study on here. Notice something. What do you notice? 0.662. What do we see? What does that mean? We have more stocks declining today than advancing today. Isn't that interesting? More stocks declining today than advancing. Just scroll through the S&P 100 here. You'll see that. More stocks declining than advancing. And frankly, over the last couple of weeks, going back to the beginning of December, that's exactly what's happened almost every single day, with the exception of 2, maybe 3 days. We've seen more declining issues than advancing issues. How many times have we seen this degree of lack of breadth as the market is close to touching all-time highs again? Again, what does it mean? We circle back. It means that these companies are going to save the market or not save the market. And right now we're testing at a critical level. We're seeing volatility at extremes we've not seen at least since last December. And you can say, yeah, the market didn't sell off. Yes, most of the time it does. 5 to 10%, maybe even more. But remember, in that 5 to 10%, you might have a 46% drawdown, a 49% drawdown. What kinds of stocks do you own? Last week during my session, I talked about Palantir. Yeah, I've been sluggish on Palantir back here in the mid 60s, but here's the deal. You say, yeah, but it went to 80. Okay, great. It went up 33% over how many weeks? 2 to 3 weeks? Okay, great. We also had what? Right there, we had a $10 range. 15% in one day. And we're hardly batting an eye, frankly, right? Volume was extreme. This stock could drop 33% in a day, right? It takes 33%, it takes, a few weeks to go up 33%. And all of a sudden you're holding on to it. It's down 33% in a day. Did you sell it? Oh yeah, it went to 80. Did you sell it at 80? Probably not. So the question becomes, how do you be long while at the same time understanding that market conditions are very troubled, right? Meaning that the downside risks are fairly significant. You look at SPX, for example, notice this rising wedge. If we had an oscillator down here like a stochastics RSI, you would see a divergence developing over the last 3 highs. But that doesn't matter to the permables, right? Risk does not matter. But this is precisely the point where we have to start to weigh the risks of the market to the downside, because it's probably been a good year for you. You want to finish strong. Okay, so if you're long the market, maybe you take the same tact as a lot of these managers out there that are rotating towards these big names, as Google down here. Talked about Google back here, why Google's undervalued and may play catch up. It's definitely played catch up, right? And we just broke out to a 52-week high. Maybe you own Google. Maybe you own Amazon, right? Maybe pick a couple of these stocks that make sense to you from a risk and reward perspective. Just be ready to sell these, right? Because if the market goes down, these stocks will go down too. Now let's look at something like Rivian. Rivian's exactly the kind of stock that could be down 50% tomorrow, right? It's done it in the past. So why think it can't happen again when it can? But today was a phenomenal day. We had this, in my sessions, we played this. We got over 100% gain in Rivian going into this December expiration. And we took it last week off, and today we're breaking out again. Our target was the 161, around 15. It touched it, we've backed off it, and now we're bouncing. What's the next level? Well, this is the seed wave back here. We're planting a tree. Can the tree extend to 18 or possibly even 2350? Absolutely, right? It's all a matter of probabilities. So we look at it today and say, okay, why today? Certainly it's a big move. We have above average volume. Those are all great phenomenon that are happening. But if we look out here at February, for example, look what else is going on. There's a lot of call option buying at the $18 strike price. Go back to the chart. $18 happens to stand at our 261% projection. We're expecting the stock to get to 18. Now the question is, can you trade it? Buying the stock's tough. How do you manage risk? You can have a planned exit, a stop loss, etc. But what are you doing to manage risk? You can't do it if a stock gaps through it. This stock has 100% volatility, right? 93%. So the S&P is at 14%. How many times more volatile is Rivian over the next 67 days? Or better yet, 93% over the next 30 days. $3.50. This is a $15 stock. Again, remember, the S&P, the VIX is at 14.5. So this is what? 7, 8 times more volatile? Is that what you want right now? This is the kind of company, Palantir, MSTR, the market catches a cold, you get pneumonia, right? Assuming that something, doesn't offset it, news, etc. But what about this? On Rivian, can you trade the upside? There is opportunity. Why? And able to do it on a limited risk basis. Notice the volatility, 79, 83, 86, 88, drops there a little bit, bid-ask spreads wide, 92. Volatility is rising as you move out of the money. I can buy a call at a lower volatility, and I can sell a higher strike price call at a higher volatility, making this spread relatively cheap. Well, if I look here at maybe 10 days, can I get an 18? Sure. Can I extend it out here, maybe even 46 days or 39 days, for example? I've got 50-cent increments. I could buy a 16 and I could sell an 18. And that's going to cost me less than 70 cents. So if I go buy deep and wide, 1 month 4-strike vertical, all of a sudden what? That cost me 57 cents. I risk 57. My upside's $1.43. And in fact, if you could make 70, 80% on that, you might want to close this spread, and guess what you can do? You can roll it. You can move it to a higher strike price. Maybe the stock's up here at 18, 18 and a half. Just move this vertical up to 19 and 20, 19 and 21, 19 and a half and 21. And now all of a sudden you have another spread that's benefiting from the skew, and you have a very cheap cost. You've potentially rolled it, taken all of your risk off the table. And by the way, you still have the upside. Maybe you captured 30% of your upside to 18. Maybe at 19, you roll it, and maybe you got a 20, 22, you capture another 30%. But you're doing it with little to no risk. That's the important point. Risk and reward. Avago today, again, I mentioned those puts. Again, that may be poised to see a bit of a correction. All you need is to retest the low of the gap day. You can balance it out, bullish and bearish trades. Whichever hits first, the next 30 days you're closing out and potentially rolling it if you think there's more potential upside. So we've got Rivian, I just talked about Palantir, et cetera. But this is, again, how you might consider playing. Until when? So we start to see something happen. And that probably means downside. And as the downside materializes, and then we start to see these volatility measures come in, now all of a sudden it creates an even better reward to risk scenario to play that upside again.